Now, let's take a look at making the right operational decisions. After we have made the right investment decisions, it is important to be able to run our business smoothly and fruitfully. We will help you to examine company data and learn a simple analysis technique to make the right decisions. In this section, we focus on, firstly, the role and structure of each element of the financial statements in evaluating a company's financial health. Secondly, applying key indicators and making use of the financial statements when making decisions about running the business. Thirdly, using key rules to keep the company away from risks and to generate higher profits. Last but not least, we introduce certain key differences between IFRS and VAS to help managers accurately analyze financial statements prepared under VAS. As a financial manager, you must determine the financial health of a company to assess its ability to operate and develop new projects. The most official and effective way is by understanding and analyzing its financial statements. The objective of the financial statements is to provide economic decision-makers with useful information about the company's financial performance and changes in its financial position. So what are financial statements? Financial statements are a set of reports answering the question, what is the company like? Financial statements are comprised of two primary statements, the balance sheet and the income statement, and other reports such as the cash flow, statement of retained earnings, and notes to the financial statements. By using the data provided in the financial statements, investors and managers can calculate various indicators to support their decision-making process. The financial statements present an overall picture of the company's financial situation. In the Operational Investment Decision module, we will guide you as you explore financial information through the following 5 chapters: balance sheet, profit and loss account, P&L, or income statement, cash flow statement, owner's equity statement, and the key differences between IFRS and VAS. Finally, a conclusion and a short quiz are presented to test your knowledge. The learning goals of this module are to be confident when reading and analyzing company data sourced from financial statements prepared under both IFRS and VAS. Assets are the resources the entity controls and from which it expects to gain economic benefit in the future. Assets include non-current assets and current assets. Non-current assets are assets the company expects to use in its activities for a period exceeding 12 months. They include 2 major elements: fixed assets and long-term investments. Current assets are comprised of property with a short-term life cycle, mostly limited to 1 year, and liquid assets such as cash, bank accounts, and short-term investments. Current assets are easier to convert into cash than non-current assets. Liabilities are usually classified into short-term and long-term liabilities and reflect the obligations the company must pay to third parties. Equity, a stock or any other security representing an ownership interest. Equity belongs to the stockholders and consists of capital stocks, retained earnings, and the net result, which corresponds to the profit or loss earned or incurred during the financial year. In terms of leverage, assets show details of the company's DOL, degree of operating leverage, and liabilities and equity show the DFL, degree of financial leverage. Short-term is less than 1 year, and long-term usually lasts longer than 1 year. Answer the following question. Is a company's financial position at a specific point in time reported in the balance sheet or income statement?
Congratulations, that's the right answer. The elements of the balance sheet, assets, liabilities, and equity show the financial position of a company at a given point in time, while the revenue and expenses in the income statement show the company's financial performance over a period of time.